Hi, everyone. Welcome to today's webinar with myself, Fawad Razaqzada. I'm the market analyst here in London with Think Markets. Also in the room is my colleague, Victor, who is going to be... Oh, hi, Victor. How are you doing? UK?
Yeah, looking forward to finally getting our minds around what Jay Powell has to say in Jackson Hole this week.
Yeah, that's the main event really for the markets, isn't it? I mean, we've got a few data releases here and there, but all the focus is on the Fed chair, who will be, I believe he's speaking on Friday.
Yeah.
Is that correct?
Yes, that is correct.
Yeah. Okay.
Alongside with many other central bankers,
Yeah.
probably most of them not physically in Jackson Hole, but still.
Yeah. Yeah, indeed. So we will we'll discuss that in greater detail and share some live charts with you guys in a minute or so. Before we do that, it's important that you are aware of the risks involved in trading. So please have a read through this. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. All right. So, yeah, so it's the Jackson Hole meeting this week, and the markets are today in a kind of a holding pattern. We saw a big rally for risk assets yesterday. If I show you, for example, the S&P 500, we broke to a new record high. Big, sizable rally on the S&P, and we saw big gains for things like crude oil. You know, big rally here. I think it was one of the strongest rallies in months for crude oil. Certainly weeks. Gold
it
rose
was
further.
about 6%.
Indeed. Gold also rose sharply, 1.36%. Copper, likewise, rose. So it was a broad-based rally for all risk assets. And if you look at the commodity dollars, for example, the New Zealand dollar, it has extended its gains overnight. We saw the Australian dollar rise as well. The Canadian dollar rose against the US dollar quite sharply. This was a projection from previously, by the way, from a previous webinar, which was drawn when price was trying to break out of this formation. It did do what we thought it might do, take out this high, which it did, and now it's gone back down. So anyway, we'll talk about the dollar CAD in a minute. So, you know, we saw this broad-based rally for all risk assets and safe haven currencies. The Japanese yen.
It keeps treading water.
It does, yes. It's kind of stuck between a hard place and a rock. But the dollar index itself, you know, it fell because of the strength in the euro. It took out the March 2021 high, and it's gone back down inside this zone. So what caused all of this?
So, I was gonna ask you, do you have any ideas as to what changed yesterday?
Well, not much changed. I think one thing that
nothing really
has slightly changed is the fact that the Jackson Hole meeting is now going to be a virtual event, meaning that it's highly likely that the Fed is no longer going to announce its tapering plans. Previously, some analysts had expected the central bank chair to spill the beans, so to speak, on tapering QE. But because of the rising Delta cases of COVID and some weakness in US data. Analysts are now expecting the Federal Reserve not to, they're expecting the Federal Reserve to remain tight-lipped and perhaps wait until the September meeting to then provide us some more clues in terms of when the tapering will take place. So that's one thing. Also, we had some positive news in regards to the vaccinations from the US, with the FDA, the Food and Drug Administration, granting full approval of the COVID-19 vaccine developed by Pfizer, which raised hopes that perhaps people will kind of be forced to companies may force its employees, for example, to get vaccinated. So there's some hopes that the vaccinations could accelerate in the US, which should kind of offset some of the negative impact of the rising Delta cases in the US. So those are the two things I could think about that's changed. But in the grand scheme of things,
right,
there wasn't anything significant, right?
The only significant thing is that we've had this pretty significant rally in the dollar over the past several months, and now that Jackson Hole is upon us, and we know that we're not going to get the date on which the Fed is going to start tightening. However, we might get some more clues about the Fed's thinking and how it intends to proceed, what would be the pace, etc. So I think that September is not an active meeting. But is the next one in the beginning of November? If I'm not mistaken, it should be.
I think so.
But that meeting is pretty much active. And basically, we're going to get some more information about the Fed's thinking this Friday. And the market has been pricing in this hawkish rhetoric over the past several months, really, since the beginning of July, if I'm not mistaken. Sorry, since the beginning of June.
Maybe June,
when we had the first signals that the Fed is starting to get cautious about the levels of inflation. So the November 3rd is D-Day, and the market is starting to price that in. Is there anything left to price in? I'm not so sure. So let's see what J. Powell delivers and see how this unfolds.
There's always the risk that J. Powell may surprise the markets and give us more.
He has done so in the past.
So always take that into consideration if you're trading this week, because we could see a surprise, and he could be more explicit about the timing of tapering and so on, which means that the market is likely to trade in ranges ahead of Friday's speech. So if you're trading the currency markets, just have that at the back of your mind, not to expect too much follow through in either direction. I would think. Expect ranges to hold, and from a trading point of view, take it from one level to the next and move on to the next opportunity. So overall, given the false break on the dollar index, the dollar's short-term trend is kind of tilted a little bit to the downside. However, I wouldn't read too much into this, given the macro events that are the main macro event on Friday that's upon us now. So I think that the bullish trend for the dollar is still intact, but the kind of failure to hold above the March high for the dollar index is obviously not a great sign if you're a dollar bull in the short term anyway. So now let's go through the currency pairs and look at them in great detail. This is what I was expecting. Well, I was waiting to see what might happen at around 117. Well, it didn't pan out this way at all. I thought that we will get a sell-off and hold below 117. That could then lead to further follow through on the downside to take us below 116, which is this low here, and potentially see rates drop to 115. That is still a possibility, by the way, because we haven't broken out of this falling wedge pattern or bearish channel or whatever you call that. And if the Fed is hawkish on Friday, we could certainly see euro dollar drop to 115. So that's still a possibility that that could play out. Remember that the European Central Bank is considerably more dovish than the Federal Reserve, and that dovishness is going to weigh on the euro until and unless something changes significantly. So expect the rallies on the euro to be short-lived until something changes. As such, if you're bearish on the dollar, I wouldn't play it against the euro. I would play it against one of the other major currencies, but certainly not the euro. In contrast, if you're bullish on the dollar, then looking for short opportunities on the euro dollar makes more sense to me than otherwise. So let's see what happens. I mean, I can get rid of this now because it didn't play out this way. What we want to see in terms of the euro dollar is if you're bullish now, you want to see a higher high. So in the short term, the buyers would turn bullish if we get a break above this high at 1805. Ideally, maybe 119 even, which is a more significant high here. But I think above 118 will take us above the resistance trend of this falling wedge pattern. So technically, that would be a positive sign, right? In terms of resistance, well, resistance is being tested right now. This level here was previously support. It's now possibly a resistance level to keep an eye on at 117.50. Previously, we bounced here. We broke below it, tried to stay above here, but couldn't. So now it's being retested as potential resistance. And we've seen a bit of a rejection there already today. Let's see if there will be any downside follow through or not. I'd imagine we will hold inside this falling wedge pattern until at least Friday, when Powell is going to be speaking. But the downside levels for me. On the upside, a break above 118 with target 119 initially, possibly 120 thereafter. But I'm not expecting too much of a upside for the euro dollar, even if the Fed turns out to be dovish on Friday. The Fed chair, I should say. I think you share those views as well, don't you, Victor, on the euro dollar?
Well, at this point in time, I feel like some price action consolidation around 117 is likely, and after Friday, I guess I'll have some more thoughts on the matter.
Yeah.
But until then, I feel like the range trade could be persisting over this week.
Yeah.
And we're somewhere between 1750 and 1650 in terms of the euro dollar.
Okay. So yeah, we both don't expect to see any significant moves ahead of the Fed meeting.
Yeah, so
Fed
maybe
speech,
I guess then the market is gonna do something really sharp and unexpected.
It's always like the case, isn't it? When you think the market is heading one way because of X, Y, and Z, and then it surprises you. Happens to all of us. In any case, the pound now is obviously had a decent recovery as well, along with all the other markets yesterday. It's now testing resistance around this level. This level is 137.30, which has been a short-term pivotal level. So it's possible that we may see some weakness come back into the pound from around this level, given that we have broken below the 200-day moving average and the 21-day exponential is now starting to head below the 200-day average, which is a potentially bearish sign. The situation in the UK is, I think the data has softened in recent times, along with the global trend, but it hasn't deteriorated significantly to warrant a major shift in policy stance from the Bank of England. So the Bank of England was never going to raise interest rates anytime soon. But with the inflation data weakening a little bit, the pressure has eased off the central bank. So I think, the cable, it doesn't make sense to concentrate too much on the dollar pairs, because all the dollar pairs are going to be trading in kind of ranges ahead of Friday. So let's look at the pound in relation to the euro, or in relation to the yen. And the euro pound rather has bounced off this key area of support. I still expect that level to break eventually.
I think so, yes.
Yeah, leading to a potential drop to 83. Yeah.
Yeah, we've had some significant signs that the UK economy is doing much better than expected after Brexit. In terms of exports, in terms of unemployment. Actually, today I was looking at some stats that showed that there are way too many open positions, and that could be a short-term hindrance to the economy. There is the capital that needs labor, and there is no labor. And why there is no labor? Well, guess what? The EU laborers are not coming to the UK anymore.
Yeah.
So
that's inflationary, isn't it? I mean, it should push up wage inflation in the UK.
It should put up, it should lead to wage inflation, and hopefully for the dreamers out there, to higher productivity rates. But which actually is what matters in the long run for any economy. Higher productivity leads to higher growth, leads to higher rates, and lower inflation. However, for that to happen, we need something to cave.
Sure.
So let's see what caves first, and I would feel like the euro would be the one to go.
Indeed.
Because the performance indeed of the UK economy has been much better than expected, and much better than the protracted fear-mongering on part of many political players in the UK.
Yeah. So
and outside of the UK.
And outside as well. So while Victor was telling you all about the fundamentals of this cross, I was busy, as you can see, drawing some levels on the chart, updating the levels. I have put this black line below this thrust candle. The reason for that is because this candle right here is on the day that the euro pound broke out of this small consolidation range, and so if this is a genuine bullish breakout, this support area should hold now as support, leading to another push higher. However, obviously our base case is that price will break down, and one of the ways to potentially look for a trade idea is to wait for price to go back below this thrust candle, thus trapping thus providing us a signal that it has trapped the bulls before potentially breaking lower. So for me, a break below 85.05 is the signal I'm now looking for in terms of anticipating a breakdown in this pair. The pound against the Japanese yen is at resistance at the moment. This area right here, as you can see, was support. Then we broke below and closed below before price bounced back, and it's now testing this area as resistance. So are we going to see an inverted hammer-like candle on the pound yen? If so, we could see another sell-off to test the prior lows and significantly the 200-day moving average as well. In contrast, if we move now above this level right here, the high of this latest move up that kind of failed at 151.41, I think that would be a short-term bullish development leading to another test of the 61.8 Fibonacci retrace. So the Japanese yen is kind of, it's shown some strength in recent times, not just against the pound, but across the board. If you look at the euro yen, the New Zealand yen, obviously New Zealand has had a really strong performance of late across the board, but since May, the Japanese yen has been rising generally across the board against the Canadian yen, Canadian dollar as well. The Canadian dollar has bounced off a very nice level against the Japanese yen at around 85, or just slightly below it, because that level was previously resistance. We broke above it. This is a potentially bullish scenario because it also shows that there's a possible failure of this head and shoulders formation here. Left shoulder, head, right shoulder. Broke below the neckline here, but it was quickly rejected, and we've seen some upside follow through. So perhaps the Canadian dollar against the Japanese yen may have resumed its long-term bullish trend, but for confirmation, we'll need to see a break above the most recent high, which comes in at around 88.50. So it's still some distance to go before it confirms this potential reversal. But in the short term, the path of least resistance clearly to the upside, which may suggest, therefore, that other yen pairs will follow suit. So if you look at the Aussie yen, well, the Aussie yen has pulled back significantly compared to the rest of the Japanese yen, because the Japanese pairs, because of the lockdowns in Australia. I think more than half of the country is still in lockdown in Australia due to the Delta variant of COVID over there. But as far as this pair is concerned, obviously this will be the second or third day that prices have staged a recovery. How far will it go remains to be seen. It will depend to a large degree on the general appetite for risk, which at the moment is still somewhat positive compared to yesterday. You know, we've seen some of the indices like the FTSE struggle again, but it's you know, if you look at China overnight, we saw a bit of a recovery in Chinese markets. US futures are up. This is the Russell 200. Dow kind of flattish. S&P is it was up earlier, it's now gone flat. Nasdaq is positive still on the session and at a record high. This was the old previous the old record high. So overall, the sentiment is still positive, and that should mean that you know, if the sentiment can remain positive, then the Japanese yen could start to weaken again and provide support for the likes of CAD yen, Aussie yen, New Zealand dollar yen, etc. But now that we are talking about the indices, let's have a look at them in greater detail. The Nasdaq continues to lead the way once again because of the technology sector outperforming. And that's all to do with global yields remaining subdued. Here, you can see the 10-year US bond yields not moving much at all, despite yesterday's risk-on rally. The weakness in yields is what is helping to keep the technology sector supported in particular, because there are lots of growth stocks in the technology sector. Growth stocks tend to do well when yields are falling or not rising. And for that reason as well, the German DAX still holding its bullish trend line that has been in place since March of last year. It has had a few tests of this trend line and bounced from it each time. It is sitting very close to its previous all-time high. Unless something changes, I think it's going to break higher. Likewise, if you look at the other European major indices, this is the EUROSTOXX 600, I think. Yeah. Previously, I think last week it was hitting, or the week before that, repeated all-time highs before coming back down a little bit. But now it's staged a bit of a recovery from the 21-day exponential and is on the rise again, although it has come off the highs today, along with some of the other European indices. But yeah, generally speaking, the trend is positive for the major indices, and I think the mood will remain positive in the run up to the Jackson Hole meeting, as Powell is seen to kind of soften his hawkish tone from last FOMC meeting. Commodities, what do you think of crude oil, Victor? Because crude oil has gone down and then it's gone back up, hasn't it?
Yeah, well, crude oil has had quite the move lower, about $15 lower, if I'm not mistaken. Maybe like a bit less.
Yeah.
So we've had
we have been calling this drop, hasn't it? In our previous webinars. Yeah, around $15. Yeah. You're right. Yeah, from the high.
So an extension of this move would be difficult at this point in time. I feel like the market is stabilizing and trying to find new levels that establish where some sellers are, and attempt to basically find the next weak spot in the market and push there. So I'm still inclined to short, to go short on crude oil from here, having in mind that we have lockdowns incoming, probably across some major parts of the world, considering the fact that the weather is about to turn and the summer is almost over in the western hemisphere.
Northern hemisphere, yeah.
In the northern, sorry, in the northern hemisphere, we're going to see some changes in.
So the US driving season is about to end, which should mean lower demand for crude.
Yeah. So let's see if I'm right, but this is the seasonal pattern that comes to mind, and some production in the US is coming back online at these levels. So I mean, we're still high enough for shale oil production to be slowly coming back. So let's see.
So previously, when oil bottomed out here, it did rally quite significantly for a while, and then it sold off again. Are we seeing a similar pattern? Are we gonna get a nice recovery, perhaps to, I don't know, 68 is a key level, 38.2 Fibonacci retrace meets the 21-day exponential. Maybe a bit higher than that, but ultimately, I think the trend is bearish in the short term, in the short to medium term outlook, based on not just the technicals that are showing here with price making lower lows and lower highs and whatnot, but fundamentally, what Victor just mentioned, with demand likely to weaken and supply likely to increase. So, for those reasons, I think I think we both feel that that the rally is going to stall, and we'd be on the lookout for bearish patterns to emerge. So let's see if we can kind of preempt that potential reversal on oil, looking at the price action in greater detail. And from this hourly chart, price has broken out of its most recent consolidation zone, but it's now testing the supply zone that is over here. This was where the previous attempt to rally failed. So bringing that across means that we may see some weakness here. But what we want to see from a trading point of view is for price to break below this low here and hold, and then maybe retest the area of the breakout for a potential move down. Something like that is where is what I would like to see for oil, and the entry would be somewhere here, provided that we see the drop first, and then we'd look to sell the retest of the broken level. So it's always best to wait for some sort of confirmation, but then don't wait too long, because then the move will be over before you know it, especially with crude oil, because when it starts to drop, it goes down really fast. So be very quick to read the appropriate signals that the market throws at you. So that's the situation with crude oil at the moment. With regards to gold, well, gold is testing at a very significant level today, isn't it, Victor? I mean, this trend line that we've been talking about is once again being retested. We have the 200-day moving average coming in just above it.
Yeah.
And it's broken some support, some resistance levels, like 1790, 1797 area was previously support, and it offered some resistance, but now it's gone above. So where do you see gold from here?
Well, this is another Jackson Hole play, but it seems to me that the rebound from that early Monday morning flash crash 2 Mondays ago, that significantly dented some bullish positions and surprised many people. This move has been fully reversed. And I feel like the market has shaken out some weaker longs. So at this point in time, I would be rather inclined to bet with the market, and buying on dips to me seems like the preferred strategy. I'm not sure whether we're going to take out this trend line convincingly. We do have the 200-day moving average just above, around 1810 or 12, something like that.
1810.
So we might have a test of the 200-day moving average, and some pullback from there would probably provide a good buying opportunity.
Sure. Yeah, I mean, it all depends on your outlook on the dollar. Are you bullish or bearish? I mean,
dollar,
I think it's a dollar
another
play.
Jackson Hole play, as I
Jackson
said.
Hole, indeed. Yeah. I think given the struggles of gold in the last year or so, I wouldn't be surprised if we see another move to the downside. We've seen big rallies in the past reverse. For example, here, it looked at one stage that price had broken out of this consolidation zone. It rallied sharply and then boom, it dropped. Again, in here, it took out some resistance levels, rallied for a few days, and then boom, dropped. Now it's obviously broken away from this resistance area. But if it goes back below 1775, which is the low of this candle here, if it does something like that, then I would be inclined to sell it again. So that's the bearish scenario that I am not waiting for it to happen, but if it happens, then I would look to get on board on a short trade for gold. Otherwise, I'd like to wait for more price action because we have a number of technical factors converging here, the 200-day, as Victor mentioned, the trend line. So from a bullish point of view, what I would wait for is a move above 1830, a clean break above, because previously it has stalled here on a number of occasions. So if it moves above 1830, then any rounded retest of that level should lead to some continuation to the upside. So that would be the bullish scenario. Where it is at the moment is trading in no man's land. So at this juncture, it's really difficult to have a clear directional bias, especially with the Jackson Hole coming up. So waiting is potentially a more, dare I say, safer way to get on a trade on gold, and indeed many other markets this week. So yeah, where it is at the moment, I don't have any strong views on gold. Similarly with silver, it is finding support once again from the lower end of this range at around 2250-ish. Yesterday it made a nice recovery, but the trend line is still in place. Prices making lower lows and lower highs within the overall consolidation. So like gold, I think waiting for further price action would make sense at this stage. Let's finish with cryptos then, because cryptocurrencies have been rising sharply of late. However,
they've been all over the place once again.
Yeah, I am kind of getting a little bit cautious at these levels. Yeah, because obviously there's been so much negativity towards Bitcoin, certainly towards Bitcoin compared to all the other cryptos. And Bitcoin has tested $50,000 mark once again as it rises inside this rising wedge pattern. I think if it moves below 48,000, that would be a short-term bearish development in my view, because that's the base of the most recent move up to the 50,000 mark. Therefore, if it were to go back below that level, it would create a short-term breakdown in the structure of higher highs and higher lows. If that happens, then we could see a drop to 46,000, where we have the 200-day average converging with support right here. What it does thereafter remains to be seen. But some of the other cryptos are showing relative strength. For example, this one, Cardano, or whatever you call that, broken above its previous high that was hit in May. This is a daily chart.
Yeah.
You have Ethereum showing relative strength in the sense that it has tested the 61.8 Fibonacci retracement against its all-time high, whereas Bitcoin didn't quite get to the 61.8. Yeah, crypto gold didn't quite get to the 61.8 before reversing a little bit. So the altcoins are showing somewhat more of bullish price action, and compared to Bitcoin, I continue to see Ether as the next best thing. And for me, this crypto has a lot of potential, but from a technical point of view, let's see if it now breaks above the 61.8 and hold there. If it does, then I would imagine the next stop would be another all-time high above the peak created in mid-May. Obviously, if it breaks the bullish trend before that, then that could complicate the technical outlook.
Yeah.
I can't see any questions from the attendees that have joined today. If you have any questions, please ask now.
Yeah, if you have any questions, we're here to answer those.
Sure.
Did we miss anything? I don't think we really did.
No, we didn't.
Just be wary of the key macroeconomic event on Friday, and do note that existing home sales is later today, which could move the market somewhat.
Yeah. Apart from
yesterday?
that, we don't have too many macro events.
Oh no, yeah, it's today, yeah.
Yeah.
Apart from that, we do have durable goods and the preliminary GDP figures on Wednesday and Thursday for the US. However, that is not something that is really market moving, especially considering the fact that
Jackson holds the next day. Talking about GDP, I know it says preliminary here. This will be the second estimate of US GDP. They have another version called advanced, which came out previously.
Advanced.
Yeah. So just bear that in mind. Also, this GDP is backward looking, obviously, looking back at the second quarter. I think investors will not care too much what happened in the last quarter.
Yeah, the key question for investors and for traders is whether the momentum can carry over from the second quarter into the third.
Indeed.
Until the end of the year, really. Because the base effects are starting to change, meaning that the further into the year we get, the less pronounced the pandemic impact is going to be.
Yeah.
And this is also valid for inflation numbers. So let's see how this goes.
Indeed. So things like consumer sentiment, which is a more forward-looking data, is the sort of stuff, or inflation expectations, the sort of stuff that the markets are more focused on at the moment. Obviously, the PMI data as well, because they provide like early indications about, how the economy is performing. Pay more attention to forward-looking data is what we're trying to say. Fed Chair Powell is speaking at around 3:00 on Friday, so that's the time you need to be at your desks. Okay. Before that, we do have a couple of other macroeconomic events. Most notably, the core PC price index, which is the Fed's favorite measure of inflation, apparently. Inflation is obviously a hot topic, no pun intended there. But yeah, that's going to be something to keep an eye on as well. If you found this webinar useful, please make sure to join us live next time. You can do that by going to our website, Market Analysis, and then go to live webinars. Here you will see a list of upcoming webinars. You can register for them by clicking on the register button. For those of you who are watching us live today, thank you so much for joining us, and we hope to see you again next Tuesday. Take care. Bye-bye.
Bye-bye.